Welcome to our class, our video class on technical analysis from the Quantitative Methods Applications study session. In terms of technical analysis, there's a lot of detail in the reading that I don't think you'll be held responsible for, but we really need to be familiar with the types of indicators and how some of them are used within technical analysis. So let's start out here talking about some of the principles and assumptions of technical analysis. The idea of technical analysis, which is analysis based really on just trading information, volume and price trend information, or daily values, weekly values, any kind of price and volume data. So the idea is that stock values are determined by supply and demand, which I think we can all agree with, and they're driven by both rational and irrational investor behavior. Now, technical analysis uses these price and trading volumes to analyze change in supply and demand and identify trends that persist for long periods, and trends and patterns that repeat themselves, and they have to repeat themselves in predictable ways for technical analysis to be useful for making your trading decisions. Now, fundamental analysis, which we focus on mostly in the CFA material, look for changes in intrinsic values. So we're trying to see what prices should be, trying to value stocks and find out, or other securities, and find out where they are trading versus where we think the value is, and make trading decisions based on that. Now, with technical analysis, we try to predict price changes through the analysis of the past trading behavior. So what are some of the advantages of technical analysis? Well, the claim is that it's based on actual trade data, whereas fundamental analysis is based on accounting numbers, which can be estimates. Technical analysis can be used for assets with no cash flows to be discounted for valuation. So when we get to something like valuing gold, which has no cash flows for us to discount and no intrinsic value for us to come up with, fundamental analysis falls a little short. And the idea is that technical analysis can give us some information and help us predict price movements in some of these commodities with no cash flows. And one of the good advantages of technical analysis is we don't have to learn all that accounting stuff. What are some of the disadvantages? Well, if the markets aren't liquid so that the trading data isn't continuous and good, technical analysis may not work. If there's manipulation, if they aren't free markets, then technical analysis will have trouble. In terms of bankrupt companies, we may see a stock price approaching zero, but short covering to realize profits may create some positive technical patterns that can't be relied on. Now, if markets are weak form efficient, and by weak form efficient, the hypothesis of weak form price efficiency says that past trading information cannot be used to make positive risk-adjusted returns on average. So if markets are weak form efficient, then technical analysis won't convey any trading advantage. That said, let's look at some of the tools that technical analysts use. And the first thing we want to talk about is line charts, bar charts, and volume charts. Well, a line chart just connects closing prices. So you see some sort of a jagged line trending up and trending down. A bar chart, for each bar, as it shows on the slide here, it shows the high, it shows the low, and the close for the period. Now these can be daily, weekly, 10 trading days, whatever period the analyst wants to use. But you see a lot of information is right in there, the open, the close, whether the close was higher than the open, and where they are in relation to the high and low for the trading day or other trading period. A volume chart underneath that usually will show the volume for the period that we're looking at. So with a daily chart, we'd have daily bars, and then we'd also have the daily trading volume down below. A couple other charts that are used. On the left we have this point and figure chart. Now a point and figure chart is a little bit different in that along this axis, along the bottom here, this is not time. Each of these columns represents a change in direction. And so these X's are uptrends and those O's are downtrends. Now we can set the parameters of this chart. As we see it here, each box is $0.50 if those are dollars on the left-hand axis. So we set the size of the boxes, and then we also have to determine, well, how many boxes does it have to move before we declare a reversal? Now this has a small reversal over here, if you take a look, of only 2. So it seems to take only $1 in the other direction for us to record a reversal there. So here we go, X, 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 X. That's an upward price trend, but then it turned down and went down by more than $1, so we start the downward price trend down here. And that could go on for any period of time. And then we see another reversal in trend, and we measure the uptrend. Then we see another measurement, another reversal, and we measure the downtrend. To the right of this, we have a candlestick chart. And these candlestick charts, this one's going to show up moves as a clear candlestick. Okay, and a down move as a filled-in solid candlestick. Now, if we draw this candlestick, and I'll draw one here for you, not very well, but it's got the wicks on it, and it's got the candlestick. So this is going to be the low. The top of this wick is going to be the high for the period, and again, it could be a daily or weekly candlesticks, whatever the analyst is using. Now, with the clear one for the up move, we'll also have a line here for the open and a line here for the close. With the down move, those are the dark ones that are all filled in, and then the open would be above the close. So that's how these prices are represented with candlestick charts. Another tool that technical analysis uses is trend lines. An uptrend is characterized by both higher highs and higher lows, and you see an uptrend illustrated on the left-hand side here. There we connect the lows to get our uptrend line. On the right, we've got a downtrend, and we can use those highs there to draw the downtrend line. So these are trend lines, and the idea of looking at these trends is we have to decide if they're going to continue or if they're going to reverse. So as we look at some of our other technical indicators, they are going to be confirmations or indications of reversals of a current trend. The ideas of support and resistance are important in technical analysis. When we talk about support, it's a price where buying pressure limits a downtrend. And resistance, price where selling pressure limits an uptrend. So resistance to upward movements and support from falling further. And some examples of support and resistance are trend lines, old highs, which can be resistance, old lows, which can be support, and sometimes just the psychology of round numbers, whether it's 10,000 on the Dow or a price of 50 on a stock may have support or resistance characteristics. So if we just go back to the previous slide for a minute, this uptrend here becomes our support. And this downtrend is resistance. You can see that price goes up to that line and then bounces off, and goes up to that line and bounces off. And that's the idea of a resistance line. Now, we've got a principle here called the change in polarity principle. The idea is that if we break through a resistance level, that resistance level then becomes a support level. And if we break through a support level on the downside, then that becomes a resistance. That's our change in polarity principle. Let's take a look. So, We've got a resistance level there. We've drawn a line across the highs. We seem to be in an uptrend right now, but bouncing against resistance. Now, if we break through that resistance, then that resistance level becomes a support level for trading after that. That's our change in polarity principle. Now, what are some common chart patterns? Well, common chart patterns can either indicate reversals or they can indicate a continuation of the trend. Now, what we've drawn here kind of quickly and funnily is what we call a head and shoulders pattern. A head and shoulders pattern has a high in the middle. It's got shoulders of about equal height. Okay? And this is a reversal pattern. If we saw this pattern, we expect at this point from this head and shoulders for the price to decline from there. Now, we can also have an inverse head and shoulders, which is the same pattern but upside down. And in that case, it's a reversal of a downtrend. Also, double and triple top formation. So what's a triple top? Well, if we come up like that, a triple top, that signals a reversal. To a technical analyst, that would mean a decline. A triple bottom, on the other hand, would mean just the opposite, a change in trend from a downtrend into an uptrend. Now, the opposite of a reversal pattern is going to be a continuation pattern. And these are indicators that the prior trend is expected to continue. And we've got two illustrated here, triangles and rectangles. You can see with the triangle that we're in a downtrend, and then we get the triangle formation, and then out of the end of that triangle, we get a continuation of the downtrend. And that continuation, if we had to guess the magnitude of it, we'd guess the size of this triangle when we enter the triangle as the size of this continuation in the downtrend. Same thing with a rectangle. Now, pennants are just triangles on short-term charts, and flags are rectangles on very short-term charts. But we use them the same way. Now, a price target can be calculated by technical analysts for the ensuing trend. Now, here we're talking about measuring the size of the pattern. We're going to project from the neckline. We've got a head and shoulders pattern here. Okay, we've got our shoulders about level, and we've got a head here in the middle. So not quite as wild as the one I drew on that other slide, but still pretty wild. And so let's take a look here. Here's our head and shoulders. Well, there's our neckline, as it's called. And so in order to predict the size to get a price target for this downtrend because of the reversal based on the head and shoulders formation, we'll measure the size of the pattern from the neckline to the top of the head, and that's the size that we predict for our price target for our downtrend. Okay, moving averages. Moving averages are a very commonly used tool. What they do is they smooth out, they take noise out of stock prices or any asset prices, price series. So to take a 20-day moving average, we just add up the prices, closing prices probably for the last 20 days, divide by 20, and that's our 20-day moving average price. Now the larger n, the more days we put into it, the more it smooths it. Well, you can go too far and smooth it all out and fail to recognize trends. With too short a period, you haven't taken out enough noise, so you're getting signals based on noise instead of really basing it on changes in the trend. And technical analysts very often use a shorter term moving average versus a longer term moving average to identify continuations or changes in the trend. Now, you can see our longer-term moving average here is our 100-day moving average, and you can see here our shorter-term moving average is cutting through that from above. That's referred to as a dead cross and indicates to a technical analyst that the price will fall or continue to fall because it's already got to be falling. The trend has changed and changed significantly enough that that shorter-term moving average crosses through the longer-term moving average from below. On the other hand, when that shorter-term moving average cuts through that longer-term moving average from below, then we call that a golden cross. That's an indication of a continuing uptrend above that. Now, it's not quite represented on this chart. Well, sometimes these things just don't work out. What are Bollinger Bands? Well, Bollinger came up with these bands, and what it is we take a moving average, okay, and then we draw bands above and below the moving average based on the volatility of the stock. So we take a set number of standard deviations, like say 1 standard deviation above or below, 2 standard deviations above or below. So we're kind of measuring the volatility of the stock and looking at the smoothed moving average line. Now, as a short-term indicator, we could sell at the top of the band considering the securities overbought and buy at the bottom of the band considering the securities oversold. It's like the series is mean reverting toward the moving average line. When it gets too far above that, it's overbought. We want to sell those securities. When it gets at the bottom of that, it's oversold. We want to buy those. As a short-term indicator. Longer term, when stocks break out of these bands, that's taken as a signal that we really have a trend in place. So we would buy on a significant breakout above the top Bollinger Band and sell on a significant breakout below the lower Bollinger Band. Here's what we're looking at here is those Bollinger Bands. So now you see here is the moving average line is this one right here, and then we've got the bands above and below that. And see, this would be an indication we're at the top of the band. That would be overbought, time to sell this security. Here, time to buy that security. Here, time to sell that security, etc. So that's how we use our Bollinger Bands for short-term indicators. And let's see if we have a breakout on here. I think, well, it's hard for me to tell. We break out, nope, I don't see one. But remember, that's a longer-term indicator that a trend has developed outside of this kind of trading range around the moving average. Now we've got some things called momentum oscillators. One thing you should know about oscillators is we're going to use these oscillators as a confirmation of a trend, or if there's a divergence between the movement of the momentum oscillator and the trend line, then we think maybe the trend's not going to continue. At least that's the technical analysis story. So these momentum oscillators are scaled indicators. And they can be scaled like between 0 and 100, okay, or around a value. Often they'll go around a value of 100%, right, above and below that or above and below 0, depending on how the indicator is structured. Or they can oscillate between two values, and then we look at the extremes, the extreme lows and the extreme highs. If they're oscillating around a value, then we say, well, when it gets far above that value or far below that value, those are going to be our indicators. Now, extreme values of these momentum oscillators indicate overbought or oversold markets. And so we're going to say these are contrarian trading signals. When we're talking about technical analysis and we're talking about a contrarian signal, that means you're going to do the opposite of what's appearing in your indicator or in the market. Now remember, these are indicators we want to use with something else to identify convergence or divergence of the price movement and the oscillator movement. When they converge, it's an indication that the trend will continue. When they diverge, it's an early warning of a change in the direction of the trend. So here we have a price chart and an oscillator. And we've got an oscillator going between 0 and 100, I guess, and we see an uptrend here marked by this line, and we see a downtrend in the oscillator. And so that would indicate divergence and a change in the trend. Some other oscillators. Here's a rate of change oscillators. Now certainly for the exam, I wouldn't expect, and the LOS don't seem to indicate that you're responsible for any of these calculations. So please just take these as examples of oscillators that are used and see how the construction puts them either oscillating around 0 or around 100. Now that first one there, we see the difference between the price on one day and the price some days prior, however long that period is, and then we multiply that times 100. Well, that's going to oscillate around 0 because that term in parentheses can either be positive if the stock price has gone up or negative if the stock price has gone down over the last n days. Now typically n is 10 days, but different analysts are going to use different values there. You see in the second one, we've got one price over another price, so that's going to be greater or less than 1, depending on if it's in an uptrend. It'll be greater than 1. We'll multiply that times 100 and get a value greater than 100. If it's in a downtrend, we'll get a value less than 1 right here. Make my pen a little bit fatter. Feel better about it. There we go. That's a little easier to do. So if that's less than 1, we're going to be below 100. And if it's greater than 1, we're going to be above 100. So typically, and these are just the defaults, okay, but if this rate of change oscillator crosses above 0 or 100 during an uptrend, that would be a buy signal because we've got convergence of the movement in the oscillator and the movement in the trend. It would be a sell signal if that rate of change oscillator went below 0 or 100 during a downtrend. That would signal, again, that's convergence, and that would signal a continuation of the trend. If your oscillator and your price trend are in opposite directions, then you don't know what to do. More analysis is required. Here's a relative strength index. Now here we have the sum of changes, and don't get this confused. This is an oscillator. Don't get this confused with relative strength indicator where, and I think we'll see this in just a minute, but in a relative strength indicator, we're looking at the movement of a stock price relative to the movement of the overall market. This is a little bit different, this relative strength or RSI here. We're going to take RS, which is the sum of all the positive changes in the last n days, over the sum of the negative, the price declines over the last n days. So we take 1 plus that ratio, divide it into 100, subtract it from 100. Well, what do our values mean here? Well, this is an oscillator that oscillates between 0 and 100. And again, we're going to use it as a contrarian index. So we have over 70 is overbought and under 30 is oversold. So this oscillator, when it's low, indicates a buy. So if we were in an uptrend with a low indicator here, then we would have convergence of this oscillator with the price trend. A stochastic oscillator, and remember, I'm giving you here just some examples of oscillators to get you familiar with them, because a lot of these values change. Our default range on this one, for example, is 14 days, but that period can vary. Also, these values here of 20 and 80 may be naive. It's suggested that those are kind of the defaults, but in fact, those might not be the appropriate ones to use. Now, what's going on with this one? Well, we're calculating percentage K. Notice that we've got the high. If we're using a 14-day period, we've got the high and the low for the 14 days, and then we plot the current close on that. Well, this distance here as a percentage of the whole range is what we're after, and that's our percentage K. Oops, excuse me. Meant to clear that off, not change it. That's our percentage K right there. As we've shown it, this is 60% of that overall range. Now, our percentage D line, our signal line, is the 3-day moving average of these values right here. So take the 3-day moving average. So now we've got a short and a long term. We can look for these crosses, but we can also look at these values here. But as I suggested, it's not necessarily true that 20 and 80 are the right numbers to use for overbought and oversold. You may look at this indicator for an individual security and see that it always bounces between 30 and 70. Well, in that case, 30 would be your oversold mark and 70 would be your overbought mark. And these 14-day periods and these numbers can be specific to individual securities. Now we've got moving average, convergence, and divergence. Again, we've got two lines that we're going to use. One is our moving average convergence divergence line and the signal line. So our moving average line here is the difference between two exponentially smoothed moving averages. Now that's a little different than just adding them all up and dividing by n, or 12 or 26. When we say exponentially smooth, we're putting a little less weight on older data and a little more weight on newer data. But no calculations of this are required, and I don't think this definition is really required by the learning outcome statements either. But what we're doing is we're taking the difference between the 12-day and 26-day moving average, and of course that can be positive or negative depending on whether we're in an uptrend or a downtrend. And then the signal line is an exponentially smoothed 9-day moving average of these differences between the two exponentially smoothed moving averages. Now this oscillates around 0. It can either be positive or negative. But the idea is the same. When this shorter term line crosses the signal line above, that's a buy. So it's like when we talked about the golden cross before. When it cuts through the longer term moving average from below, that's a buy signal. When it cuts through when the shorter term cuts through the longer term from above and goes below it, that's a sell signal. Now we'd like to talk about some sentiment indicators, and sentiment indicators can be used either as a contrarian indicator or as just a straight indicator that we go along with it. Now we've got opinion polls. You'll see surveys of how many advisors are bullish and the ratio of bullish to bearish investment advisors, those sorts of opinion polls. But here's an opinion poll where they have to put their money where their mouths are. Put volume relative to call volume. When put volume is greater than call volume, it means that there's negative sentiment. Investors are getting nervous. They're buying more puts to protect them from falling stock prices than buying calls to position themselves to benefit from increasing stock prices. So these are our sentiment indicators, but mostly these sentiment indicators are used as contrarian indicators. It seems to be the case that at market tops we have a great amount of bullish sentiment and low bearish sentiment. Bullish sentiment meaning you think the market's going to go up some more. Bearish meaning you think it's going to go down. So both these opinion polls and put-call ratios are used as contrarian indicators. The technical analyst is going to recommend doing the opposite of what we're seeing the emotions are in the market. The CBOE, Chicago Board Options Exchange Volatility Index, is high when investors fear market declines, and this is also used as a contrarian sentiment indicator. So when investors are bearish, they're worried the VIX goes up, then contrarians get bullish and position themselves to profit from market increases. Excuse me. Margin debt. Well, when margin debt goes up, okay, that's taken as sometimes a contrarian indicator, because at market tops, the amount of margin debt employed is typically cyclically high. We also have short interest ratio. It's the number of shares sold short as a percentage of daily trading volume. And sometimes that's also called the days to cover. How many days average trading volume would it take for the shorts to cover their positions? So if they've sold shares short, that is, they've borrowed shares they don't own and sold them in the hope of replacing those shares, buying them back at lower prices. So if we use this as a contrarian indicator, then a large short interest ratio would indicate oversold, and a contrarian analyst would take that as a bullish or a buy signal. Our next category of indicators is flow of funds, trying to look where the flows of cash are within the investment universe. So this first one, sometimes called an ARMS index after Mr. Arms that invented it, but also called TRIN for trading index. It looks at the activity in advancing stocks versus the activity in declining stocks. We can also look at margin debt as a flow of fund indicator, and flow of funds indicator, and mutual fund cash position. The idea is that in uptrends, mutual funds have low cash and they have high cash positions, that is, cash that has not yet been invested in securities during downtrends. So fund cash is potential buying power, right? If mutual funds have a lot of cash on hand and they see the trend is changing to up and they have to get invested, that represents a lot of buying power. So mutual fund cash position is used as a contrarian indicator. High cash positions, bullish. Low cash positions, taken to be bearish. Another flow of funds has to do with new equity issuance or secondary offerings of already trading stocks. New equity issuance actually does increase the supply of shares, and given that there's a limited amount of investment funds, new offerings coming to market and peaking are often coincidental with declines in overall index values. One of our last topics here is cycles. Technical analysts, at least some technical analysts, look at cycle theory. We've got these Kondratief waves, which are 54-year cycles. One of the troubles with these is we don't have that many 54-year cycles to look at in the developed equity markets. This is made up of 18-year cycles. 3 times 18 is 54. There's also evidence about some decennial cycles of 10 years each and presidential cycles in the U.S. based on the 4-year presidential terms. The evidence is that the first and second year of the presidential cycle offer the worst performance in the markets, and the third and fourth year the best performance. And I think that's particularly true with equity markets. Now, with Elliott wave theory, the idea is that market prices move in interconnected cycles that range from very short-term, so we've got short-term cycles, we've got medium-term cycles, we've got long-term cycles. And what they've identified here is that uptrends consist of 5 up moves and 3 down moves. Now this says waves, but remember, a wave's not an up and down. A wave is just one of these movements. We'll show that to you in a second. So downtrends, 5 down and 3 up. Uptrends, 5 up and 3 down. And that's pretty easy to remember because 5 ups is bigger than 3 downs, and that must be an uptrend. Now these wave sizes supposedly conform to Fibonacci ratios. The Fibonacci sequence of numbers is just a sequence of numbers where we add the two previous ones together. So as you can see from this, 0, we start with 0 and 1. 0 plus 1 equals 1, 1 plus 1 equals 2, 2 plus 3 equals 5, on up. And then they also work quite a bit with Fibonacci ratios, which are ratios of Fibonacci's numbers, like 5/8 or 8/13. Now we can see these impulse waves and corrective waves. Here is the 5 up, okay? 1, 2, 3, 4, 5. And then the 3 down, 1, 2, 3. And then a change in trend again, back to the uptrend. So these are wave patterns within larger wave patterns. The downtrend, you see our impulse waves are 1, 2, 3, 4, 5, and then our uptrend is 1, 2, 3, and then a resumption of our downtrend. And our cycle names, grand supercycle, supercycle, cycle, primary cycle, intermediate cycle, and minor cycle. I'm glad we didn't have to draw all of those. The last topic here for us is intermarket analysis. Now there's certainly a relationship between bond prices and interest rates, and between interest rates and stock prices. So we may see sometimes a divergence that when bonds go up, it's because interest rates go down, but money moving into bonds may be money not moving into stocks, and vice versa. So intermarket analysis looks at these interrelationships. And these could be equities, bonds, currencies, commodities, all are interrelated. And then we can look at industry groups too, and what's going on with energy versus utilities, or healthcare versus financials, telecom or consumer discretionary spending. And then we can also look at intermarket globally. London versus New York Stock Exchange versus Tokyo, Hong Kong, or Germany. Now these relative strength charts, and when we're talking about relative strength here, we're talking about the price of, say, an equities index versus a commodities index, or energy versus the S&P, Microsoft versus information technology sector, or perhaps the 10-year Treasury bond versus the S&P 500. So if we're thinking about the 10-year Treasury versus the S&P 500, that will be high when the bond price is high and the equity market is low, and extremes of these tend to indicate inflection points where after a period of money moving out of equities and into bonds, that switches, and the idea is we get into a longer term trend the other way where money is moving out of bonds, bonds are falling, and moving into equities, equities are rising. So this relative strength indicator would reach a peak and then go into a prolonged downtrend after that. Well, this is just an overview of some of what's done in technical analysis. I suggest you look specifically at the learning outcome statements to see exactly what you're supposed to know. And most of it we've managed to get in here. About the reversals, about confirmations of trends, about shorter term moving averages moving through longer term moving averages, how oscillators are used, and some of the basic chart patterns and charting methods that technical analysts use.